Schools drill us on history, science, and equations, but never on the money rules that shape our future. That's why millions struggle with debt, savings, and financial security. The system won't teach you, but we will. These 10 personal finance rules could change everything. Miss them, and it could cost you. Schools teach math, history, and science, but they never cover how to manage your paycheck. That's why so many people struggle financially, even with a steady income. The key to staying ahead isn't earning more, it's controlling where your money goes. Start by tracking your income and expenses, so you know exactly how much is coming in and going out. Follow the 50-30-20 rule, 50% for needs, 30% for wants, and 20% for savings or debt repayment. Use separate bank accounts for bills, savings, and daily spending to prevent overspending. Review your budget every month and adjust as needed. Budgeting isn't about limiting yourself. It's about building financial security and freedom. Relying on the 10% savings rule might have worked decades ago, but today it's a one-way ticket to financial stress. With rising costs, longer lifespans, and unexpected expenses, saving just 10% won't be enough to retire comfortably or build real wealth. Instead, aim for at least 20% to 40%. The more, the better. Start by automating your savings, so money moves to your savings or investment account before you can spend it. Cut back on silent budget killers. Unused subscriptions, eating out too often, or impulse buys add up fast. If saving more seems impossible, focus on increasing your income. Freelancing, skill building, or side gigs can help. The real key? Make saving a habit, not an afterthought, so you stay ahead financially, no matter what life throws your way. One unexpected expense, a car breakdown, a medical bill, or a job loss, can wipe out your savings and push you into debt if you're not prepared. That's why an emergency fund is a financial safety net you can't afford to skip. Aim to save at least 3 to 6 months' worth of living expenses in a separate, easily accessible account. If that feels overwhelming, start with just $500 and build up over time by setting aside a fixed amount each paycheck. Cut back on non-essentials and direct that money straight into your emergency fund. Keep this money in a high-yield savings account so it grows while staying available for real emergencies. Without an emergency fund, you're just one financial shock away from debt. But with it, you're in control. Money sitting in a regular savings account won't make you wealthy, but money invested and left to grow can turn into a fortune over time. That's the power of compound interest. Your money earns interest, and then that interest earns even more interest. The earlier you start investing, the less you have to save to build wealth. For example, investing just $100 per month at an 8% return could grow into over $150,000 in 30 years without lifting a finger. Use tax-advantaged accounts like an IRA or Roth IRA to maximize your gains and reduce taxes. The key is to start as early as possible, even with small amounts. Compound interest rewards time, not timing, so the sooner you begin, the richer your future self will be. Credit can be a powerful tool or a financial trap. It all depends on how you use it. A strong credit score helps you get lower interest rates on loans, better housing options, and even job opportunities. But maxing out credit cards or making late payments can wreck your finances for years. The key is to use credit wisely. Keep your credit utilization below 30% and always pay your bills on time. Avoid high-interest debt, like payday loans or carrying a balance on your credit card. If you have debt, focus on paying off the highest interest loans first, while making minimum payments on the rest. Credit isn't the enemy, bad money habits are. Use it responsibly, and it can open doors to better financial opportunities. Earning money is one thing, keeping more of it is another. Many people lose thousands each year simply because they don't understand how taxes work. Before accepting a salary, always check your after-tax income. what you actually take home. Use tax-advantaged accounts like AIRA to reduce your taxable income while saving for the future. Take advantage of deductions and credits. Many people overpay because they don't claim what they're eligible for. If you're self-employed or have a side gig, learn about business deductions that can lower your tax bill. Most importantly, don't wait until tax season to plan. Smart financial decisions throughout the year can help you keep more of what you earn. A single unexpected event, a car accident, a medical emergency, or even a lawsuit can destroy your finances if you're not protected. That's why insurance isn't just another bill. It's a shield against financial disaster. Health insurance is a must. Without it, a hospital visit can cost thousands. Auto insurance protects you from costly repairs and liability in case of an accident. If you have family members who rely on you, life insurance ensures they're financially secure if something happens to you. Home and renters insurance can protect your property from unexpected damage or theft. To avoid overpaying, compare policies regularly and adjust coverage based on your needs. The cost of insurance may seem high, but the cost of not having it could be far worse. Student loans can feel like the only way to afford college, but borrowing too much can trap you in debt for decades. The good news, there are smarter ways to get a degree without drowning in payments. Start by applying for scholarships and grants. Millions of dollars go unclaimed every year simply because students don't apply. Consider community college for the first 2 years to save thousands before transferring to a university. Work part-time or freelance while studying to cover expenses instead of relying on loans. If you do need to borrow, only take what's absolutely necessary, not extra for lifestyle expenses. A degree should open doors to a better future, not lock you into years of financial stress. Many people delay buying a home because they believe they must save 20% for a down payment, but that is not always necessary or the best strategy. While a larger down payment lowers your mortgage, waiting too long can actually cost you more. Home prices and interest rates continue to rise, meaning the longer you save, the more expensive homes become. Instead, look into first-time home buyer programs and low-down payment options such as FHA loans with 3.5% down or conventional loans with as little as 3% down. What matters most is being financially prepared for monthly mortgage payments, property taxes, and home maintenance. Renting while trying to save 20% might feel safe, but if home prices rise faster than your savings, you are falling behind instead of getting ahead. The key is to buy when you are financially stable, not when you reach an outdated savings goal. Good health isn't just about avoiding medical bills, it's the foundation of a successful and financially secure life. When you're healthy, you have more energy, better focus, and higher productivity, which means you can work harder, think smarter, and seize more opportunities. Poor health, on the other hand, leads to fatigue, missed work days, and lower performance, which can hold you back from achieving your financial goals. The best investment you can make is in yourself. Exercise regularly, eat nutritious food, and get enough sleep. Small daily habits like stretching in the morning or swapping processed food for whole foods don't just improve your well-being. They also boost your efficiency, creativity, and ability to earn more. The stronger and healthier you are, the more control you have over your future and financial success. These 10 finance rules can be the difference between struggle and financial freedom. Which one surprised you most? Drop a comment. If this helped, hit like, subscribe to Money on Point and share it. More game-changing money tips coming soon. Stay tuned.